Welcome to the Clara and Julian podcast. No fluff, just margins. Like, subscribe, and hit the bell to stay ahead of the curve.
So picture the ultimate store of value. For over a century, the financial world has sold you this very specific, deeply ingrained image of an impenetrable vault. Thick steel doors, biometric locks, and sitting right there on a velvet cushion is an asset completely insulated from market carnage.
Right, a physical hedge against inflation.
Exactly. Something immune to the wild swings of the tech sector or the decay of fiat currency.
Which is, it's a beautiful fiction, because if you open that vault today in 2026, you will find that the physical asset hasn't been stolen, but its underlying liquidity has entirely evaporated.
Oof, gone.
Completely gone. Vaporized by a massive supply-side shock and a fundamental misunderstanding of what gives an asset its price floor. We are basically looking at a structurally obsolete commodity currently undergoing a violent repricing.
And that is precisely what we are tearing apart today. In this deep dive into the global diamond market, we have a massive stack of intelligence on the table here. We've got 2025 and 2026 financial market reports, geopolitical trade analyses detailing international smuggling routes, and some really brutal secondary market data from jeweler buyers.
And a historical reading passage that perfectly encapsulates the mythology we are about to dismantle.
Oh yeah, we are going to dismantle it. Because our mission today is to strip away the romantic PR and analyze these stones purely as an asset class. So if you, the listener, have ever viewed a diamond as a store of value or a safe place to park capital, you really need this financial reality check to protect your portfolio.
Well, to understand the collapse, we really must first dissect that foundational myth. The industry has historically relied on a narrative heavily rooted in rarity and geological prestige.
The whole diamond dream legacy scam.
Basically, yes. If you look at the historical text provided in our sources, it illustrates this psychological conditioning perfectly. Diamonds have been valued since antiquity, revered simply because they were the hardest substance on Earth, forged exclusively under extreme, unreplicable subterranean pressure over millions of years.
Unreplicable until we figured out how to build better machines. But go on, sell the romance.
Well, the romance is what built the multi-billion-dollar market cap, right? The text highlights the 3,106-carat Cullinan diamond, which was pulled from the dirt in South Africa in 1905. It eventually yielded the 530.2-carat Star of Africa.
Right.
But the narrative focuses entirely on the immense, nerve-wracking human effort required to process it. The meticulous calculation required to cleave the world's largest rough stone without shattering millions of dollars of potential value into useless dust.
Which is insane risk.
Exactly. And for generations, the cartel has conditioned consumers to repose absolute trust in the intrinsic value of these legacy stones based on that exact historical prestige, the illusion of profound scarcity.
Okay, I have to stop you. That entire historical lore is nothing but a highly leveraged, incredibly successful PR stunt. It's a narrative engineered by a legacy cartel simply to obscure the basic chemical reality. Diamonds are, at their core, just common carbon masquerading as a premium asset.
I'm not disagreeing with the chemistry, but the market
It's an artificially constrained supply chain designed to prop up a rock that you dig out of the dirt. And the market is finally waking up to the fact that we don't need to dig anymore. The synthetic revolution isn't just a trend, it is a massive engineering win, executing a perfectly aimed kill shot on a legacy monopoly.
You view it as an engineering win. I view it as the ultimate commodity trap. You are completely ignoring the behavioral economics of luxury.
I am looking at the disruption of a totally inefficient system. Look at the actual mechanisms here. We are deploying high-pressure, high-temperature presses, HPHT, and chemical vapor deposition, or CVD.
Right, the lab-grown methods.
Yeah. We are taking a sliver of diamond seed, pumping methane gas into a vacuum chamber, hitting it with microwave plasma beams, and literally raining carbon atoms down onto that seed. We can transmute basic graphite into a stone that is an exact atom-by-atom facsimile of a mined diamond.
Optically and chemically identical, yes.
Identical. So why would any rational buyer pay a 50% premium for blood, dirt, and cartel markups when a lab in Silicon Valley can grow absolute perfection in a matter of weeks?
Because perfection in infinite quantities is worthless.
It's a superior product.
The technology is ruthlessly efficient, yes. Lab-grown diamonds, or LGDs, use up to 90% less CO2 to produce, and their manufacturing costs have plummeted by 60% in just 36 months.
Which is incredible.
It is, but that hyper-efficiency is exactly what destroys their investment profile. By mass-producing these stones, the engineering sector has turned them into nondescript assets. Do you understand what happens to a luxury category when the supply curve goes vertical?
The consumer gets a flawless product, and the legacy miners get a lethal supply-side shock. The market data shows LGDs are capturing over 50% of the engagement ring market share. That is a total victory.
Volume does not equal valuation. Retail investors always miss this. The diamond market historically functioned as a Veblen good.
Right, the price paradox.
Exactly. For the listener unfamiliar with the term, a Veblen good is an economic paradox where demand for a luxury item actually increases as the price goes up. The exorbitant price is the feature. It signals status. If every consumer can easily obtain a flawless Type 3 3-carat stone for a fraction of the historical cost, the foundational allure of exclusivity is dead.
Type 3 being the purest, nitrogen-free crystal structure, the absolute rarest tier in nature, which we now just, print on demand.
Precisely. Historically, only 1 or 2% of mined diamonds were Type 3. Now, essentially 100% of lab-grown stones hit that metric. When supply becomes infinite, every facet of the LGD market screams commodity. The Gemological Institute of America even had to revise its grading standards late last year. Oh, wow, really?
Yes, they abandoned the granular 4Cs for lab-grown stones and moved to basic, premium, and standard tiers.
Because there's no variance.
Exactly, because there was too much homogeneous perfection flooding the market.
Yep.
You cannot grade rarity when everything is perfect.
So the Veblen good dynamic just totally collapses. The price floor vanishes because the status signal is gone.
Which is a disaster for any investor holding the physical asset. If we scrutinize the 2026 secondary market data, the financial postmortem is objectively brutal. Let's just look at the resale value cliff.
Yeah, let's talk about the market carnage.
Historically, a natural diamond will depreciate 50% the second you walk out of the retail store. The jewelry industry built a brilliant psychological firewall to prevent people from ever trying to sell them. They called them family heirlooms.
Right, to lock up the secondary supply.
Exactly. But if you actually try to liquidate a natural stone, it's a terrible hold for a portfolio, yet the lab-grown market is vastly worse. The valuation haircuts in the synthetic space are staggering.
Right.
We are talking about an asset acting exactly like the collapse of fast fashion. It's just a race to the bottom on unit economics.
It is a total lack of liquidity. According to the 2026 Engagement Ring Resale Report, the secondary market treats lab-grown stones like outdated consumer electronics.
Wow.
You buy a laptop today, it's worth nothing in 3 years. If you purchased an LGD ring for $5,000 3 years ago, current resale offers hover between a devastating 10% and 30% of the original price.
And that is only if you can find a buyer willing to take the liquidity risk at all.
Precisely. 1-carat LGDs are currently retailing for under $1,000 new. Why would a jeweler buy your used lab-grown stone when they can order a freshly printed one from a wholesaler for practically nothing?
They wouldn't, which makes holding these stones a severe quandary for any rational investor. I want you, the listener, to seriously ask yourself, how many other so-called investments do you hold that lose up to 90% of their liquidity the moment the transaction clears?
It's frankly embarrassing.
It is. You have an asset that yields absolutely nothing, generates zero cash flow, and ironically costs a fortune just to appraise. You wouldn't tolerate that in equities, you wouldn't tolerate it in commercial real estate, but put it in a velvet box, and suddenly intelligent people completely ignore the math.
Well, they ignore the math because the industry equated price with emotional weight for 100 years. But the macroeconomic environment of 2026 doesn't care about emotion. The synthetic market has triggered a massive deflationary spiral, and the geopolitical friction we are seeing right now is a direct response to that panic.
Oh, absolutely. Governments and cartels are desperately attempting to artificially prop up the natural side of the market through regulation.
It is the desperate flailing of a dying monopoly, yes.
They are trying to build bureaucratic moats because their actual product can no longer compete.
Let's examine the geopolitical data impartially, though. The G7 and the European Union implemented heavy sanctions targeting Russian diamonds, specifically Alrosa, which historically supplied a massive percentage of the world's rough stones. The financial impact of the sanctions is significant. Alrosa reported a 25% decline in revenue, dropping to 134.3 billion rubles, alongside a 42% collapse in core earnings.
Which is massive.
It is. The political intent of the G7 is straightforward: to choke off funding by isolating the world's largest rough diamond producer from Western luxury markets. But the actual market result is immense supply chain friction.
Friction. I mean, it's a logistical nightmare deliberately engineered to punish the midstream market.
Well, it has forced the implementation of what the industry is calling a traceability tax. Full EU traceability requirements were completely postponed to January 2026 because the logistics were impossible to execute.
Shocker.
The new mandate relies on blockchain tracking, specifically platforms like De Beers tracker system. The goal is to digitally map a single stone from the moment it leaves the mine all the way to the retail counter in Paris or New York. And the compliance costs to maintain this ledger are astronomical.
It is completely absurd. Think about the mechanics of this for a second. The natural diamond industry is desperately attempting to remain impervious to market evolution by slapping a digital DNA label on their rocks.
To artificially verify origin.
Right. They are forcing jewelry retailers to buy into an expensive mandatory software subscription just to prove the origin of a rock that looks identical to a synthetic one printed in a lab yesterday. These blockchain certificates aren't adding intrinsic value to the diamond.
No, not at all.
They are a massive bureaucratic tax designed to save an antiquated business model. They're quite literally selling you the paperwork, not the product. And the ultimate irony, the sanctions aren't even working.
No, they aren't. The trade flows have naturally adapted to bypass the friction. The reporting clearly indicates that rough stones are simply being routed to non-sanctioning friendly proxy countries, primarily India, specifically the cutting centers in Surat and Armenia.
They're being laundered. It is an international chop shop for carbon.
The mechanics of the evasion are simple enough. A sanctioned Russian rough diamond is shipped to a proxy country. The moment a laser slices that rough stone into smaller, polished pieces, its legal identity is essentially erased.
That's wiped clean.
Exactly. It gets reclassified, mixed with legitimate supply, and miraculously rebranded with new paperwork claiming non-Russian origin. They are actively arbitraging identities. The volume of Russian stones eventually entering G7 markets remains largely unchanged from pre-sanction years, which proves the legacy supply chain is fundamentally broken.
Because you cannot enforce artificial scarcity on a globally fungible asset when the entire midstream market is financially incentivized to evade you. I mean, the regulators are playing a game of whack-a-mole with a commodity that all looks exactly the same under a microscope.
The arbitrage only exists because the top tier of the luxury market still demands the natural product despite the sanctions and despite the synthetics.
So now.
True. However, the compliance burden, that traceability tax we mentioned, is compressing margins for everyone. The fundamental structural issue remains unchanged. You have a highly fragmented, politically volatile, legally dubious natural supply chain competing against a perfectly scalable, hyper-efficient synthetic manufacturing base.
Which is exactly why the smart money is completely abandoning the jewelry market. As a venture capitalist looking at this data, the consumer retail sector is a dead end. The real value of the carbon crystal isn't sitting on a platinum band on someone's finger, depreciating by the hour.
You're talking about the industrial side.
The actual play here, the real upside that the market is ignoring, is the industrial short.
So you are pivoting away from aesthetics entirely and focusing on the material science applications.
I'm focusing on where the capital is actually flowing. We need to look at what these CVD and HPHT labs are building for the future. The jewelry was just a proof of concept to fund the R&D.
To scale the presses.
Right. The end game is synthetic diamond semiconductors. We are talking about advanced optics, quantum computing components, and elite thermal management systems for next-generation AI chips.
Ah, the thermal dynamics. That is the critical factor there.
Exactly. Silicon is rapidly hitting its physical thermal limit. When you run next-generation AI models, the processing chips generate so much heat they will physically melt if you don't cool them. Diamond has the highest thermal conductivity of any known material on Earth.
It acts as an incredible heat sink.
Yes. A synthetic diamond wafer pulls heat away from a processor exponentially faster than copper or silicon without conducting electricity. Furthermore, nitrogen-terminated lab-grown diamond coatings, where the surface of the synthetic diamond is chemically altered at the atomic level, are already proving to drastically reduce mineral scaling in massive industrial infrastructure.
It basically repels buildup.
Right. That is where the engineering actually wins. High-tech industrial application is the only place where this stone actually scintillates for an investor looking for exponential returns. You short the retail romance, and you go intensely long on the silicon replacement.
It is a cold but mathematically sound thesis. As the cost of synthesis inevitably approaches the floor, the utility of diamond in high-performance computing becomes highly scalable.
Infinite scale.
If we synthesize the data we've covered today, the conclusion on the retail side is absolute. The secondary market has spoken, the geopolitical friction is unsustainable, and the technology is advancing too fast for the legacy cartel to contain. Buy a diamond for love if you must, but never call it an investment. It is just expensive charcoal with a better marketing department.
And that is the reality of the vault we opened at the beginning of this deep dive. The diamond asset class as a retail store of value is effectively dead. It's been disrupted by scalable tech, crushed by a total lack of secondary market liquidity, entangled in a geopolitical compliance nightmare that forces buyers to pay a premium for paperwork.
It has transitioned from a revered Veblen good to a heavily depreciating consumer commodity.
Which leaves you, the listener, with a final, fascinating paradox to consider as you review your own portfolio. As lab-grown technology scales to infinite supply printing flawless stones for both engagement rings and quantum supercomputers, will the very concept of preciousness completely decouple from physical scarcity?
The shift from physical to digital value.
Exactly. Think about that blockchain ledger, the De Beers track system. In the near future, as infinite synthetic perfection floods the globe, will the verified cryptographic digital data proving a natural stone was pulled from the earth actually be worth more than the physical diamond itself?
A market where the receipt is more valuable than the asset. A perfect reflection of 2026.